Hey, good afternoon, everyone. Hope you enjoy our Q session. So, I'm Rela. I'm a programmer. We have an entertainer, we have an educator, now just a programmer, right? So, I'm probably the youngest, the most inexperienced of the three speakers. So, I'm going to talk about something after that. So, I'm able to leverage technology in our trading this. Okay, so today's topic will be how are these expert advisors to optimize forex trading in uncertain times. So, I think it's very relevant in this drop lah. So firstly, let me introduce my team. We are a team of 7. We are the other team from many professional companies. And we have seasoned finance professionals, entrepreneurs, software engineers like myself, and data scientists. We came together with a common interest and passion for the Asian markets. And let me share some of our goals. Right? Firstly, profitability. We are built for long-term growth, not just short-term hype. Our system delivers steady and reliable returns. Next, we have risk management. Every trade we do has defined risk. So, be it stop loss, the sizing, or even hedging. So, I will survive the bad days and try for the good days. So, totally fully automated. Our systems are fairly automated. We do want iterations, we do a delay. We can leverage on 24/7 trading, your precision and discipline. Fourth, strategy optimization and adaptability. So the market is always shifting. So do we. Yet we want to make sure that our strategies are always changing and adapting to the markets. Based data driven, we also want our strategy to be data driven, no guesses, everything is probability. Also for scalability, regardless we trade 1,000 or 1 million, we want good results. Yeah, we'll move on to the topic of the day, expert advisors. So can I have a show of hands? How many of you here heard of the term expert advisors? So for those who don't know, this presentation will be a little technical, but let me explain to the best of my abilities. Right, so an expert advisor is just a trading program written for MetaTrader 4, MetaTrader 5 that automates trading. Yeah, for the forex market. So why we use expert advisors? Firstly, consistency. We don't want to succumb to emotions or bias. When you're doing manual trading, you might have a lot of emotions, and with expert advisors, we follow predefined rules, and trades are executed objectively. Next, speed and efficiency. These expert advisors can execute the trades in microseconds. So heroes like us, maybe we just have a bit of lag, or at any time that we lose out on these opportunities. So next of all, the forex market is operating 24/5. Because using expert advisors, we can trade even while we are asleep. So capitalize on these kind of opportunities using expert advisors. Last but not least, backtesting. Backtesting is a very integral part of trading, and using expert advisors, our backtesting would be even better. Now, where can we find that? These are some resources we have: Facebook ads, MKL5, Telegram chats, link to success, and trading view indicators. So on the right side, you can see these are some Facebook ads I screenshot. Maybe because I've been looking up on a lot of forex, so it keeps popping up on my Facebook. So you can see no setup fee, average return of 13 to 15%. Looks very attractive. So I'll share about MQL5 marketplace. This is a marketplace where you get So this is a local place where you can see and you can pay for expert advisors. So it ranges from 50 to thousands of dollars. And you can see that there are a lot of expert advisors that you can do and leverage here. So secondly, there's also trader links. Here are the places where you can copy profitable traders. Last but not least, we have TradingView. So for TradingView, you can set your own indicators, your own alerts, or otherwise, there are free or peak indicators that you can see. You can see they are asking you or reversal, what happens here. But think note, these TradingView indicators only give you alerts of buying and selling. It is not fully integrated in MetaTrader, so it does not execute your trade. So you need an external software to receive these alerts and then translate this into MetaTrader. Okay, so we bought these resources available online. How should we choose that? So these are some key factors for selecting a reliable EA. Firstly, track record and transparency. Second, backtesting and live performance. There are some websites where people upload their performance, their account performance, their portfolio, my FX book and FX Blue. So thirdly, drawdown percentage. For those who don't know what is drawdown, it's like in stocks we have paper loss. It is unrealized loss with your open trades. Fourth, the profitability. Fifth, entry criteria. And last but not least, risk management. Now I'll show you a live snapshot of someone's account. So what are some things to take note? This is on my FX book. So first thing you think of, 169%. Looks really very good, right? So these are some things that capture our attention, and we might want to follow that or use their EA. Next, drawdown percentage, 50%. So when trading, you need to know how much is your risk appetite. Are you willing to risk 50%? If not, maybe this EA is not suitable for you. So next, balance, 10,000 balance. The higher the balance, the more likely we are to trust them, right? If the balance is $500 or $1,000, maybe their risk appetite is bigger, and then they are okay to lose 100%. Okay, next one, profit, absolute profit. Last but not least, are they transparent with their tricks? Do they only show their wins, or do they also show their losses? Now, also move on to retrading. So grid trading happens in 70 to 80% of algo trading. What is grid trading? It is about placing buy and sell orders regardless of market movement. So the goal is to profit from price fluctuations regardless of the market trend. It works very well in sideways or ranging markets, and there's no need of predicting a market direction. And best, you can automate with Excel advisors very well. So these are some features. We have dollar cost averaging parameters, ATR steps, pruning, hedging, trade filters. If you don't understand all this now, it's okay, I will go through. So firstly, parameters. We have stack. The stack, it is the movement in price before a new position is open. So this can be fixed or dynamic. So in the grid, we are opening multiple layers. So how much is the price movement before we open the next layer is called the stack. Secondly, lot size, a bit everyone knows. And third one is lot size multiplier. In a grid, if you want to do dollar cost averaging, you might not choose to open the same lot size. You might increase your lot size as we open more layers. So next one is average true range. This is our volatility compass, right? So it measures market volatility. So how much a pair thickness moves can be put from ATR, and we can size our steps appropriately based on this ATR. So what happens when it's very volatile? We have wider steps. We open the trade when the peg moves by a lot more, so that this can reduce our risk. And in common markets, having tighter steps help us get better profits. So this is a graph of average true range plotted on trailing view. So you can see 2020, 2022, 2025, they are all spikes in the ATR. Why is that so? March 2020, we have COVID. February 2022, we have the Russia-Ukraine war. And 2025, we have our favorite President Trump. Yeah, so these are the volatile periods. All these are indicators where the market is volatile. And then we decide on what strategy to use, how we do it, our expert advisors. So next one, boning. So boning refers to the act of selectively closing trades when a bit even or to take profit. So when we are in high drawdown, right, we want to reduce our drawdown when trend go against us, we trim our lot size, and at the same time secure some profits. This can help us to hit our overall TP and the XPY. So now this is an actual trade that we had, and you can see we did the initial sell here, and the price keeps going against us, and we do multiple sells. It just keep going against us, right? And this is our final sell trade. You can see here. So now what Brewing does, you can see in the first trade over here, this will be harder to close, for example. So when the price goes down, because this lot size is bigger, this lot size is smaller, and this is in profit, when we close, we can close both trades in a profitable position. This is pruning. This is how we reduce our risk, reduce our drawdown. Next, the price continues to go down. So this is our second trade. And then our second last sell trade. And again, this is in profit. This is harder to close. So we do one more put over here and we close both trades. Next, as the price continues to go up, we do one more sell. This is because we want to reduce our overall profit pricing. So we do one more sell, otherwise it's harder to close. So we do one more sell here. And then the price continues to go up and we do one more sell. As the price spikes out, right, as it goes down, we do one more pull over here. As you can see, in this sense, we already close 6 trades with 3 pruning techniques. And then a final sell, which makes us close at the absolute lowest point and take profit. So you can see, it's because of our PA strategy, we reduce our risk, reduce our drawdown, we managed to close all trades and take profit. Otherwise, it might take longer. One more example of pruning. Over here, we do a sell trade. At the top, we do another sell trade. As the price goes down, we do pull, we close. As the price goes back up, we do another sell trade. And at the end, we hit at the profit for all trades, for all the trades close at this point. So next one, we are hedging. Right, so hedging is used to reduce potential losses by opening multiple positions in opposite direction. So for example, if we have multiple buy positions, then the price drops, we might open the hedging sell order to lock in our margin and offset losses from the buy. So we keep our account balance while we wait for the market to change direction. So this is a risk management technique to limit exposure to adverse market moves, to preserve capital during volatility, and we give some time for this losing streak to recover. This is a tactic to lock your losses, right? But the issue is, when you do manual trading, for example, when you do hedging, we don't know when the market is going to turn back. So what we realized from all our trades is that we created a system to simulate this, and we should do early hedging. So with our simulator, we are able to close our open trades and hedge trades together to make a profit or even break even. And we also start to increase our hedge sizing gradually. So this shows the hedge trades, and this is the actual trades. Yeah, so what we know that is that we have to preserve capital before it's at risk. Don't wait until very high drawdown, because early hedging locks in our potential loss exposure before the market moves too far against us. The longer you wait, the bigger the drawdown and the harder it is to balance your hedge. Next, we have trade filters. So I've been covering grid trading, right? So the traditional grid trading will jump in very quickly. It works very well if the price reverses quickly in ranging markets, but if prices keep trending against us, right? Like for example, in the markets now, what we should do, we will accumulate very unnecessary early trades, increase our drawdown fast, and risk a margin blow up. Trade filters help us avoid fighting the trend too early. Let me give you an example. So over here, we do a sell, right? Prices keep going up, and then we face a little bit of drawdown. But what can happen in trade filters, using trade filters, we'd avoid trading the first 3 trades. We let those sell here. We can see that these 3 trades are all in profit because we closed at the same keep profit as compared to the previous one. These are probably in the rig, right? So with trade filters, it reduces our risk and potentially increases our profit. So these are some things that you can take note when doing grid trading with EAs. Another example might look very confusing, but it's just one buy trade over here and one sell trade here, one sell big trade over here. With trade filters, you can see one buy trade here, not very obvious, and 3 sell trades here, all profitable. So it really reduces your risk, and this is something you can use to adapt to your EA trading. Next, cascading trick. Grid trading doesn't mean we only do repairs, we only earn when the trend goes against us. We can do cascading trick. It refers to a strategy where you open additional positions as the market moves in your favor. So when the momentum is very big, we don't want to close our trades too early. So we do cascading trade. We do multiple trades in the same direction to maximize the profits and avoid closing the profitable trades too soon. So this is an example. You can see the trend here is very strong. So we can do multiple buy trades. And then only when the price starts to reverse, then we do a close off. So in this case, we compound our profits and we earn more. Same thing. The trend here, sell trade is very strong. We do multiple sell trades. It's also considered a quick trading because we open different layers, open different cells, and close it over here. So these are cascading trades. Now, for grid EA, risk management is key. Risk is never eliminated, it's managed. Some of our golden rules we have. Firstly, diversifying. Secondly, having a stop loss. Third, withdraw our profits. And last, avoid news. So firstly, about diversifying with different strategies. There's trade following, arbitrage, momentum, so on and so forth. We don't want to all use grid trading because you'll be exposed to the same risk, right? Because we don't want to put all our eggs in one basket. The markets change, situations change. There's no one strategy that works all the time. So one strategy might work during trending markets, another like grid EA works during sideways ranging markets. So using both, we are prepared for both situations and we diversify our risk. Next, reserve different assets. So Mr. Victor said focus on a few assets. For us, we use multiple assets. So we prepare a graph of Euro GBP and all this against Euro USD. So there are four other charts and against Euro USD. So we use trading view and we plot the charts. And we want to see, what we want to notice is how correlated are the pairs against Euro USD. So we're trying to find the assets that are very weakly correlated. If you cannot tell from this graph, that's okay because I also cannot tell. So luckily we have ChatGPT. So I asked ChatGPT to help me calculate the correlation coefficient against Euro USD. So just for your knowledge, correlation coefficient runs from -1 to +1. We don't want to care about the signs, we want to care about the magnitude. So as close to 0 as possible is what we are looking for. We want weakly correlated pairs. We don't want the trick to run very strongly correlated but run in opposite direction. There's no use because if one is in drawdown, the other one could also be in drawdown. We want weakly correlated when one is in drawdown, the other one is making profits. Next one, how do we choose our assets? So forex trade volume is 7.5 trillion per day. The USD related pairs are 88% and Euro USD makes up 28% of total forex volume. So the most split traded pair is Euro USD, highest trading volume in the forex market. So why did we choose Euro USD? So firstly, it has the largest market depth, so it's easy to enter and exit trades with minimal slippage. So therefore it's low spreads because of the high liquidity, and also because if it's Euro and US, there's high influence, so there's a lot of investment activity happening. Last but not least, high volatility during sessions. So during London, New York sessions, it's very attractive to traders. But this volatility, it can be a double-edged sword. It can be very good for us to get more profits, but at the same time, a little bit more risky. So you have to handle this properly. So for example, Japan yen is too volatile that we don't touch. But Euro USD, you have to find and strike a balance for this volatility. So next one, withdrawing profits is also a key risk management feature. We withdraw regularly, we save out capital. So for example, you have a balance of 10,000. You're comfortable with a 30% loss of 3K. We try not to compound because compounding will make your loss size bigger, your entry bigger, and you're exposing yourself to more risk than you actually know. So that's why we want to withdraw profits. Two kinds of withdrawing profits. Withdraw by a fixed amount, maybe when you gain $100 to withdraw, or withdraw daily, withdraw monthly. Yeah. So as long as you withdraw your profits, you are lowering your risk. Next one, super important for us, protect your capital, having stop loss. We are not as confident as the Victor who has no stop loss for New Zealand dollars. We try to have capital protection. So setting limits help prevent one bad trade from wiping out the entire account. Even if you are confident in the setup, the market can always surprise us. Trump can always tweet something and say something and we don't know what will happen. Secondly, it helps to control your emotions because we always have the mindset that, oh, maybe you'll bounce back, maybe you'll come back. So whether should we cut the loss now? We set this tight stop loss or post stop loss before you're comfortable with, and then having clear limits make your risk, make your trade more sustainable and more consistent. So next one, reinvesting profits. We reinvest into high volatility pairs, aggressive EAs, and then also review and rebalance monthly. So what happens is only use your main capital into lower risk pairs, and then those for high volatility and maybe for example strategies that comes with news or breakout, then we use our profits to trade. This might sound very like common sense, but a lot of people don't do that because when there is higher returns, people tend to transfer their money into these strategies, and then we never review, we never rebalance. At the end, it's human greed, and then we start to lose money. Next one, avoiding news and key events. Okay, this one depends on our strategy, but for Grid EA, we recommend avoiding news and key events. We know that CPI, NFP, FOMC, also our favorite, Donald Trump, we know that this is highly volatile. We try to avoid these known events and then yet prepare for unforeseen events. So it's also not about predicting the news, it's about not getting caught in it. So this is a very, very integral part of risk management. Next, we also have time filters. These are not like news filters. We restrict when we execute orders. So for example, we know Monday and Friday is very unpredictable. Regardless of what the technicals tell you, but we don't know what will happen on Monday and Fridays, avoid these days. Avoid certain hours, right? New York hours, we don't know what will happen. So we only trade when Trump is sleeping. So Asia or London hours. Yeah, there's things like that, right? So we filter our entries this way. We are reducing our exposure to very unnecessary risk. And you will see that there's always another day to trade, another hour to trade. We can always make profits. So if you didn't understand everything I mentioned just now, no worries, because I'll share about our trading system. So firstly, everything I've mentioned is incorporated into our trading system. Firstly, we have our trade simulator. We simulate the market conditions periodically to tweak our EA settings. Especially for volatile markets right now, there's no one size fits all. So we need this simulator to simulate what's going to happen, what EA should we use, what strategy should we use. And then we also have a signal bridge. So we want to get signals and alerts from those I mentioned, Telegram, TradingView, and then we use this signal bridge into enter our EA robo trading. So this robo trade has all the strategies I mentioned: pruning, hedging, news, and time filters. Last but not least, we have trade filters where we enter the grid trading at a later time, and all this leads to a diversified portfolio with different returns and different risks. So last but not least, I'll share about our performance. So we had quite a good performance of average of 20% a month, and then you can see our balance is 10,000, not 500. So as I mentioned, this is very legit. So next one, look at the drawdown, 30%. What happened is we have a stop loss of 30%. We suffered a stop loss because in November 2024, Russia fired a missile to Ukraine and there was a suspected nuclear war. So we suffered a 30% loss. So in November you can see, but actually we only suffered 11% loss in November. Because of our risk management strategy, we withdraw daily and we don't compound. So all other days we are profitable. So November we only suffered 11% loss. And we did our strategy using our simulators, all that. And actually during volatile periods in January and February is the most profitable month for us, where we have more than 50% returns. So also take note for March and April. Very low returns because when it is too volatile, we choose not to trade. Because there's always another day to trade, and with proper risk management and leveraging good EA strategies, we can make good money. So for March, we didn't trade for half the month, we still secured 20%. And for April, I think we only traded for 1 day so far. Yeah. So this is how we should just preserve our capital. It's not about earning profits. It's about staying safe and earn long-term money. Yeah. So with that, I've come to the end of my presentation. Thank you everyone for your attention.